Hey guys, welcome back. In today's video, we are diving deep into AMC confidence, investor behavior, and why both retail investors and institutions are increasingly bullish on the company. Recently, I personally added over 2,100 shares to my AMC portfolio during the price drop following the Q2 earnings report, and I am fully prepared to add more. This action reflects what the majority of apes are doing right now. Over the past few months, AMC's operations have become increasingly efficient and optimized, and projections for the future indicate that performance will only improve. Coupled with strong box office performance and upcoming releases, this has greatly boosted investor confidence across the board. Whether you are a retail investor exploring the cinema and entertainment sector, a long-term ape committed to AMC, or an institutional investor seeking a deeply undervalued asset, the outlook has become increasingly compelling. Apes are continuing to average into AMC shares, fully aware that the stock is trading at a substantial discount relative to its real value. When accounting for true price discovery and the potential squeeze price, the upside becomes even clearer, which is why retail investors continue to purchase shares every day, steadily reducing their cost basis and forcing short sellers to shoulder ever-increasing liabilities with limited options for the price to move downward. Despite recurring narratives in the media suggesting that apes are leaving AMC, that retail interest is waning, or that no one is buying shares, these claims are largely fear-based attempts to manipulate sentiment and discourage purchases. In reality, apes remain steadfast, fully aware of ongoing price suppression tactics. Short sellers have intensified their strategies in recent weeks, attempting to flood the market with negative sentiment, accelerate liquidity pressures, and intimidate retail investors into selling, yet these attempts have largely failed. They cannot access the real shares held by apes or institutions, leaving them trapped and forced to create synthetic shares through rehypothecation. This dynamic illustrates just how powerful the coordinated actions of apes and long-term retail investors can be, as collective buying forces shorts into increasingly precarious positions. At the same time, institutions have regained confidence in AMC, purchasing significant blocks of shares and recognizing the company's operational and financial resilience. Even when unusual events occur, such as temporary platform shutdowns or sudden market bluffs like dropping AMC's max paint to $2.50, institutions continue to invest, reflecting a broader confidence in the company's future trajectory. Historically, institutions were cautious about AMC due to the uncertainty caused by the COVID-19 pandemic, which affected theaters globally and made the stock appear highly risky. However, over the years, as AMC demonstrated operational improvements and maintained consistent progress in reducing debt and increasing efficiency, institutional sentiment shifted. They now recognize not only AMC's undervaluation compared to the current market price, but also the enormous potential upside from the synthetic short positions that exist. These investors have access to detailed market information, enabling them to see the volume of synthetic shares and the trapped positions held by shorts, which only amplifies their confidence that AMC is poised for a significant breakout. This combination of undervaluation, operational progress, and the impending squeeze potential explains why institutions are actively acquiring shares. A common question arises: if so many investors are buying AMC, retail, apes, and institutions, why isn't the price soaring? This is primarily due to off-exchange trading practices. The majority of buy orders are routed to dark pools, which hide their impact on visible market prices, whereas the majority of sell orders hit lit exchanges, where they influence the price downward. This imbalance ensures that upward momentum is muted, even as the true demand for AMC shares is growing. Despite this, the resilience of both retail and institutional investors is clear. They understand the manipulation and suppression at play, and they continue to accumulate shares steadily, reinforcing confidence in AMC's long-term fundamentals. In addition to operational success and investor confidence, AMC has strategically invested in other ventures, such as HYMC, which currently holds 12 million ounces of gold, valued at approximately $814 million, roughly half of AMC's market capitalization. Year to date, HYMC has gained over 100%, and with broader market trends continuing upward, AMC stands to benefit from the success of these investments. This diversified revenue stream, alongside operational performance, reduces reliance on the box office and further solidifies AMC's position as a fundamentally strong and undervalued stock. In essence, the combination of operational efficiency, strong investment performance, unwavering retail interest, and strategic institutional accumulation creates a powerful foundation for AMC's long-term growth. This confidence among investors, both retail and institutional, is precisely why apes continue to buy shares and remain committed. The market is being manipulated in ways that obscure true demand, but those who understand the system see the opportunity and continue to take action. Articles attempting to instill fear, rumors of apes selling, and short-term market bluffs have little effect on those who recognize AMC's underlying strength and the long-term potential for price discovery. With continued accumulation, operational improvements, strategic investments, and institutional backing, AMC is not only undervalued today, but also positioned for significant growth in the months and years ahead. The resilience, patience, and informed decision-making of apes and investors alike are the driving forces that maintain confidence, support the price floor, and prepare the market for future upward momentum, despite the manipulative tactics of short sellers and the complex dynamics of off-exchange trading.
Our discussion on AMC's strong fundamentals and investor confidence, it's crucial to understand the current dynamics of short sellers, liquidity, and days to cover, which are creating a unique market environment that heavily favors retail investors and institutions holding long positions. Recently, we have seen dramatic shifts in the short selling landscape, reflected in key metrics such as the days to cover, which have increased substantially. For AMC, the days to cover metric has surged, and we've observed similar movements in GME as well. This is a vital indicator because it tells us how long it would take short sellers to close their positions if they needed to buy back shares in the open market. A higher days to cover number generally indicates both increased short positions and reduced liquidity of shares available for purchase. In practical terms, this creates immense pressure on short sellers. With fewer shares to buy and high outstanding short interest, the situation becomes a ticking bomb, as any sudden surge in demand can trigger panic among shorts, forcing them to cover quickly and driving the stock price higher. This is why observing these metrics provides clear evidence of a potential squeeze building in the background. Simultaneously, the liquidity of actual AMC and GME shares continues to tighten. Low liquidity is significant because it magnifies price movements. Fewer shares in circulation make it easier for even relatively modest buying pressure to push the stock upward. This low liquidity environment is exacerbated by the fact that most buy orders from retail investors and institutions are routed to dark pools. While these purchases are real and meaningful, their effect on the visible price is muted because dark pool transactions are not reflected immediately in the lit market. Meanwhile, sell orders hitting the lit exchanges can still move the market downward, creating a distortion where the price does not accurately reflect the demand for AMC shares. Despite this, the fundamental and strategic strength of the company continues to attract investors, and the growing gap between perceived price and intrinsic value only highlights how undervalued AMC remains. Another critical component of this market dynamic is the impact of funds and ETFs that locate and provide shares to short sellers. Instruments like IWM and XRT have historically been used to facilitate short selling by borrowing shares to create synthetic positions or conduct naked shorts. Recent activity has shown significant failures to deliver, or FTDs, in these funds. For instance, nearly $3 billion worth of IWM shares failed to deliver in less than a month, while XRT has also experienced heavy FTD volumes. These failures are not just technical anomalies, they are direct indicators that the supply of shares available for shorting is under severe stress. As the liquidity of real shares diminishes, short sellers increasingly struggle to meet their obligations, forcing them to either create more synthetic shares or face escalating risk. This creates a self-reinforcing cycle. The fewer the shares available to cover, the greater the potential for market disruption and short squeezes, benefiting those holding actual AMC shares. Adding to this pressure, the reverse repo market, which provides liquidity to short sellers, has been declining sharply, recently dropping to $21 billion.
This is another key indicator because the reverse repo acts as an easy source of margin liquidity for shorts. When it declines, short sellers' ability to maintain or expand their positions is limited, effectively tightening their margin